Okay.
Being influenced by option selling firms are not always entirely caused by bears. I'm Al Brooks. Thank you for watching the Brooks Training Course. This is the 5th of 5 videos on climaxes. I want to make an important point about climaxes being influenced by option selling firms are not always entirely caused by bears. I want to make an important point about climaxes being influenced by option selling firms are not always entirely caused by bears. Finally, I'll talk about consecutive climaxes that fail. We have a series of sell climaxes. A lot of the selling is caused by institutions believing the market's going to go down. A lot of it is caused by institutions that have long positions and they think the market's going down and they're liquidating their longs, they're selling out of longs. Some institutions want to hold on to their long positions and they're looking to hedge. And one way to do that is by selling stock or stock index futures. Some institutions specialize in selling options. For example, a lot of funds buy puts to protect their stocks against losses. If the market goes down and they're holding a put, if they're long a put, the put will go up in value, offsetting the losses that they get from their stocks. There are institutions that specialize in selling options. That's all they do is they sell options. The value of the put increases as the stock goes down. Or in this case, let's say we're talking about the SPDR or an ETF, the SPY, or the stock market in general. If the underlying is going down, the stock is going down, the value of the put increases, but it's not proportional. The rate of increase of the put is called the delta, and as the market falls further and further, the value of the put accelerates upward. Its value increases faster than the market is falling. And as a result, those institutions that specialize in selling puts have losses that are accelerating as the market falls. Gamma is a measure of how fast the delta is changing. You don't need to know this. But as the market's falling, what's happening is the delta is increasing rapidly, the puts are increasing rapidly, faster than the market is falling. The result is those option selling firms are getting a lot of losses. Those puts that they sold are rapidly increasing in value. Those option firms don't want to lose money. They can't buy back their puts. They don't have control over that. What they can do instead is sell the underlying to offset the losses in the puts. As the market's falling, those option selling firms are losing money. The puts are increasing in value. They sold those puts. The firms that bought those puts are making money. The option selling firms need to do something to control their losses. Let's say this is the SPDR or the stock market. What those firms will do is sell stock or sell the SPDR or sell the underlying. And the result is those option selling firms are trying to reduce their losses by selling the underlying. If they sold puts against the stock market, there are many different ways to do that. They need to sell stock to offset the losses that they're getting with their puts. When you start to get sell climaxes, a lot of that is due to option selling firms selling the underlying, selling the stock market to try to offset the losses that they're getting in their puts. Those firms are not bearish. They don't care. They don't care if the market's going up or down. All they care about is whether they can make money by selling puts and selling calls. If a market has a series of sell climaxes like this, part of the selling is from firms selling stock because they're no longer as bullish as they were, and part of the selling is due to option selling firms hedging their losses in their short puts by selling the underlying, by selling stocks. When you see a very severe series of sell climaxes, sometimes the sell-off can be 50% caused by option selling firms hedging their puts. When you have a series of sell climaxes like this, it's not necessarily as bearish as it appears. Again, the option selling firms, they're not bearish or bullish. They just know that if the market is falling, they have to sell stock. And that means that maybe half of a severe sell climax is caused by option selling firms hedging their short puts. They're not bearish. So half of the sell-off could be caused by institutions that are not bearish at all. And therefore, consecutive sell climaxes their short puts. They're not bearish. So half of the sell-off could be caused by institutions that are not bearish at all. And therefore, consecutive sell climaxes often is far less bearish than what you think. Market's going down, the puts are increasing in value. The firms that sold those puts are losing money. The easiest way to hedge their losses reduce their losses is to sell the underlying stocks or futures. And that results in increased selling, more sell climaxes. Again, as much as 50% of a sell climax or a series of sell climaxes can be caused by institutions hedging their short puts rather than by traders being bearish. So consecutive sell climaxes often is not as bearish as you think. You have to wait until the sell climax is over and see what happens. If it's truly bearish, the market will continue down. If it's not as bearish as you think, and if it's due in large part due to option selling firms hedging, the market will either go sideways or go up. If you see this after a series of sell climaxes, you have to assume the market is not as bearish as you think, and therefore a lot of the selling was simply hedging by If you see this after a series of sell climaxes, you have to assume the market is not as bearish as you think, and therefore a lot of the selling was simply hedging by option selling institutions. There's a difference between sell climaxes and buy climaxes. Most stock is being owned by institutions. There's some stock that is held by institutions that are short, but most stock is held by institutions believing the stock will go up. Most of those firms buying want to buy value. They want to buy pullbacks. There are fewer firms willing to buy breakouts at the top of strong rallies. And the result is buy climaxes tend to be less impressive than sell climaxes. Firms who buy puts for the most part, are firms who own stock, and they're still bullish, but they want to protect themselves against losses, against the market going down, without selling their stock. Most firms that buy calls are bulls. Firms that buy puts are bulls as well, protecting their long positions. Firms that buy calls are bulls. They're buying calls instead of stock because they want to make a bet that the market's going higher with smaller risk. The firms that sell options, for example, selling calls, they do not have the same rate of gamma increase during buy climaxes as during sell climaxes because of the nature of what's going on. And the result is that buy climaxes tend to be less severe as sell climaxes. The firms that sell the calls are not incurring the losses that they do during sell-offs from selling puts. And therefore, if the market has a series of buy climaxes, the firms that sell calls are under less pressure to hedge by buying stocks and futures. And the result is they don't add to the climactic buying as much as they add to climactic selling during a sell climax. This means that, in general, buy climaxes are not as extreme as sell climaxes because they do not have the contribution from the option selling firms, or as much of a contribution. I want to talk a little bit about consecutive climaxes that fail. We have a series of sell climaxes in a bear channel, and you assume 75% chance you'll get a bull breakout, bear channel, bull flag. But sometimes instead you get a bear breakout. In general, if you have a bear breakout below anything where there's a logical stop below, there's a 50-50 chance you'll get a swing down, 50-50 chance the bear breakout will fail, and you'll get a reversal up. Bear channel, 75% down, 50-50. If you have a bear breakout below anything where there's a logical stop below, there's a 50-50 chance you'll get a swing down, 50-50 chance the bear breakout will fail, and you'll get a reversal up. Bear channel, 75% chance bull breakout, or at least sideways and then up, 25% chance you'll get a strong breakout and a swing down. Here we have a strong breakout and decent follow through below a wedge bottom. We have consecutive bear bars closing on or near their lows, and we have that one big bear bar and then a pair of additional bear bars. There's adequate follow through. We're probably going to get at least a small second leg down, maybe leg 1 pullback, leg 2, or leg 1 pullback and then leg 2, the tail on the bottom of that bull bar. Bear breakout below the wedge bottom, decent follow through. The odds are we're going at least a little bit lower. Very tight channel. We have a breakout, so the market cycle starts over again. You have to assume breakout will be followed by channel and then by a trading range. Here we got a very big trading range. Consecutive sell climaxes, you should always think of them as a type of wedge bottom because once you have 3 or more climaxes, it is a wedge. We have a sell-off, a rally, and then we're starting to sell off again. This is a double top bear flag. This is the neckline. So the first target the bears will look for, if the breakout is successful, is a measure move down based upon this double top bear flag. Whenever there's a breakout, you always have to be thinking about a possible measure move down. It might be from this high and that low, but if it falls below that, then you got to be thinking about from this high and that low. And traders will look to take profits on their shorts. Bull scalpers will look to start buying around that measure move target. A strong breakout below a wedge bottom is a low probability event, and that means bulls are trapped in. They've been buying lows for scalps all the way down, and here they're buying lows, and they're not able to get a profit. Measure move target. A strong breakout below a wedge bottom is a low probability event, and that means bulls are trapped in. A strong breakout below a wedge bottom is a low probability event, and that means bulls are trapped in. They've been buying lows for scalps all the way down, and here they're buying lows, and they're not able to get a profit. They have to sell. And you have bears trapped out. We're not selling at lows. Now they think the market's going lower. They have to sell as well. The likelihood is that you'll get at least a small second leg down. The first reversal up, the trapped bulls will sell. Out of their lungs, and the bears who did not short will sell. They'll sell the high of this bar or below the low of that bar. Here we got 2 legs down, but they're very small. That is the minimum though. The minimum is 2 legs down. Breakout, pull back, second leg down. Every trend bar or series of trend bars is a climax. We have a series of sell climaxes here. The bulls are trying to reverse up. They're breaking above a very tight channel. And then we got a very big final sell climax, bigger than all of the others. Whenever you have the biggest sell climax in a bear trend occurring after the bear trend has gone on 20 more bars, it's more likely an exhaustive end of the trend rather than a measuring gap leading to a second leg down, a measured move down. And that's what we have here. We have a gap, we have a breakout. Here, a breakout point. The rally did not go above that breakout point. You have to be thinking the market will fall for a measured move down, maybe from this high to the breakout point, maybe from this high to the midpoint of the gap, and we fell to about that level. This breakout probably was simply a sell back and test of the measured move target. There probably is other support here as well. The weak bulls finally gave up. The strong bears look at this and say, wow. Breakout point, maybe from this high to the midpoint of the gap, and we fell to about that level. This breakout probably was simply a sell back and test of the measured move target. There probably is other support here as well. The weak bulls finally gave up. The strong bears look at this and say, wow, I didn't expect that. What a gift. I better buy back my shorts. And the strong bulls look at that and say, wow, that's way overdone. And they know the strong bears will buy back their shorts. The strong bulls start to buy. And the result is you can get a bull channel that can last a long, long time. No one left to sell at this price. 75% chance you'll get 10 bars. No one left to sell at this price. 75% chance you'll get 10 bars, 2 legs sideways to up, 1 leg, pull back, second leg, maybe, but a very tight channel, probably going higher. So maybe this is 1 leg, pull back, second leg. Here we have a bear channel lasting a lot of bars, maybe 40 or 50 bars. If you look at a higher time frame chart, maybe it's only 20 bars. But in any case, it's a bear channel that's lasting a long time. In general, I'm looking for a 10 bar 2-legged correction on the highest time frame chart that has the same pattern. Let's say this is a 5-minute chart. You can look at a 10 or 15-minute chart, and the pattern might be the same. I'm going to then look for 10 bars, 2 legs on that 10 or 15-minute chart. In general, the minimum goal is 10 bars, 2 legs, and a rally that lasts about half as many bars that there were in the bear trend. A rally that lasts about half as many bars that there maybe it's only 20 bars, but in any case, it's a bear channel that's lasting a long time. In general, I'm looking for a 10 bar 2-legged correction on the highest time frame chart that has the same pattern. Let's say this is a 5-minute chart. You can look at a 10 or 15-minute chart, and the pattern might be the same. I'm going to then look for 10 bars, 2 legs on that 10 or 15-minute chart. In general, the minimum goal is 10 bars, 2 legs, and a rally that lasts about half as many bars that there were in the bear trend. So for example, if you have a bear trend lasting 50 bars, you'd expect a rally that would have 2 legs and last about 20 or 30 bars. It might last a lot longer here, but that would be the minimum guideline before the bears will start selling again. And
Hello， 这是什么？斯塔克钢铁蛋，4本书都看完了吗？没有，没有看，还没有看书。
where the bulls will stop buying. Consecutive sell climaxes, and maybe the market will bottom Sometimes when you have consecutive sell climaxes, you get one final very big sell climax. And traders look at that and they think, oh wow, it's accelerating downward and we're probably going down for another measured move. Maybe this will be a measuring gap. Usually not. If the trend has gone on for 20 more bars and you've had a series of sell climaxes and now you have the biggest sell climax occurring late in the trend, more likely it's going to be an exhaustion gap, a gap between this close and that low. Once you get the reversal up, then the gap is this high to that low. We're probably going to go back above that low. We'll probably reach the top of the final sell climax and then decide whether to go sideways and resume down or break to the upside and go up for a measured move based upon the height of that sell climax. Sometimes it happens that when you get a series of sell climaxes, you need an even stronger sell climax before the market is exhausted and you get a reversal. Experienced traders will often buy that close, betting that the market's probably not going to fall much further. Higher probability to buy above this bull bar or above that bull bar. We have a breakout. A breakout of what? Well, of this low. We tried to bottom here. You got to be thinking about a possible measure move down based upon the top to the bottom of that leg, this bottom attempt, and we fell for a measure move down. We also have a very tight channel, small wedge bottom, 3 pushes down, 1, 2, and 3. We have for a measure move down. You got to be thinking about a possible measure move down. We have a breakout. A breakout of what? Well, of this low. We tried to bottom here. You got to be thinking about a possible measure move down based upon the top to the bottom of that leg, this bottom attempt, and we fell for measure move down. We also have a very tight channel, small wedge bottom, 3 pushes down, 1, 2, and 3. We have a bear breakout below it, so there is some support there. We have a reversal up, a buy climax, and then another buy climax. This is the biggest bull trend bar in the bull trend that started over here. This is still part of the bull trend. Whenever you get the biggest bull bar late in a bull trend, 20 more bars into the bull trend, you have to be thinking that it could be a climactic end of the trend. It could be a measuring gap, this low and that high. Might get a measure move up from here to here, or from here to here. But we're about a 50% pullback of the bear trend, and we're testing prior lower highs. We're testing the top of the sell climax. Therefore, you got to be thinking that it could be a buybacking test of resistance and the end of the first leg up. Big bear trend usually evolves into a trading range, and therefore this could be a second leg trap, leg 1 pullback, leg 2 in a trading range. 8-bar bull micro channel, actually more than 8 bars, but maybe 10-bar bull micro channel. Chances are the first reversal down, traders will buy it. Chances are the bears will need at least a micro double top before they can get any kind of a correction. We have a buy climax, we have a buy climax. Sometimes you have to get an even stronger buy climax before there's exhaustion and any kind of reversal or pullback. Rather than the bull rally ending here, it had to break above the top of the entire bear trend. The biggest bull trend bar, late in a bull trend, probably an exhaustive end of the trend. You can also call it a parabolic wedge. First leg, pause, second leg, pause, third leg, or first leg, second leg, third leg. Different computers see it differently. In any case, we have a bear channel, probably will evolve into a trading range, and therefore traders will look for a top of the range. The bears thought they might have had it here for a possible double top. Instead, we broke strongly above it, and we broke above the top of the entire bear trend. However, the biggest bull trend bar, late in a bull trend, especially at the top of what could be a trading range, is probably an exhaustive end of the trend. We broke above that high, but closed below that high. The bulls are taking profits. They saw this bar as a gift. At this point, we have a 13-bar bull micro channel, 13 bars without a pullback, and it's followed by a bear bar and then a second bear bar, a bear I pattern. Bulls will sell below here if they didn't already sell out, and bears will sell as well, looking for at least a scalp down. This is unsustainable behavior. The biggest bull bar late in a bull trend, testing the top of what could be a trading range, testing the prior high, probably a buybacking test of resistance, and probably an exhaustive end of this rally. Anything that is unsustainable is usually climactic and usually results in an end of the trend. And probably an exhaustive end of this rally. Anything that is unsustainable. Is usually climactic and usually results in an end of the trend. 10 bars, 2 legs sideways. Down at a minimum. Again, different ways to look at this as a parabolic wedge, using these highs or this high and then that high.
加油!
Consecutive buy climaxes, a severe buy climax. Minimum goal, 10 bars, 2 legs sideways to down before the bulls will buy again. Here we're sideways for about 30 bars. Then the probability of trend resumption up falls to the same as the probability for trend reversal down. buy climax ended with a tight trading range. The market's in breakout mode. Here we have a double top within the tight trading range. That is a double top lower high. Here's the high, double top lower high in a tight trading range. It's a double top lower high major trend reversal. 40% chance if we fall below that bar. We'll get 2 legs down, 1 pullback 2. Bulls and bears will sell this close. They see consecutive buy climaxes. They see the biggest bull bar. They see this close below that high. Some bears and bulls will sell here. The bulls sell out of their longs to take profits. The bears sell looking for 10 bars, 2 legs sideways to down. And those who do not sell here will sell here. We have a bear II pattern, 2 bear bars. This one closing on its low. At a minimum, we'll probably get 10 bars, 2 legs sideways, maybe down. If you want, you can also call this a triangle. We have 3 reversals up, 1, 2, 3. Double top lower high here, double top lower high here. 50% chance we'll get a bear breakout. 40% chance we'll get 2 legs down for a swing down, which we did. Traders who do not want to take the early short below this bar or below that bar have a higher probability of selling after they see 2 or 3 decent bear bars. They can either sell the close, sell below this pullback bar, or sell below the low of this pullback bar. A double top this high and that high, low 1, low 2. I talked about climaxes are due to extreme behavior, extreme selling for sell climax, extreme buying for buy climax. However, a big component of the climax can be due to option selling firms losing money and having to offset their losses by taking positions in the underlying. So if the market is rallying strongly, their calls that they sold are losing money, they have to buy the underlying. If the market's selling off in a series of sell climaxes, the puts that they sold are losing money and they have to sell the underlying stocks or ETFs. And then finally, I talked about consecutive climaxes that fail. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on climaxes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on the trader's equation and probability. Perfect trades cannot exist. However, good trades exist in their common. Traders need to be able to structure trades where they have a mathematical advantage and edge. I'm going to talk about the mathematical basis of trades, and that's the trader's equation. Traders always need an edge when they're structuring a trade. Perfect trades cannot exist. However, good trades exist in their common. traders need to be able to structure trades where they have a mathematical advantage and edge. I'm going to talk about the mathematical basis of trades, and that's the trader's equation. Traders always need an edge when they're structuring a trade. That's a mathematical advantage. That means that if they take enough of a particular type of trade, they will have a profit over time. For example, we have a buy climax and a lower high. It looks like a reversal. Traders might short below the low of that bar. At this point, it's not a high probability trade. Traders might place a stop either above this bar or above the top of the buy climax. The risk is not big relative to the reward. A lot of beginners like low-risk trades. That's their greatest concern. They don't want to lose money. Their account size is small. They work hard to build their account, and they know if they lose their account, their dream of becoming a professional trader might disappear. In general, beginners like low-risk trades. However, when the risk is small, so is the probability of profit. As long as the risk and profit and reward makes sense. The trade is still a very profitable trade, but you need to balance out the risk, reward, and probability. That means you have to structure a trade that has a good balance. Some traders prefer higher probability trades, and that means they wait for strong breakouts. For example, waiting to sell once you have a pair of consecutive big bear trend bars and selling that close or selling this small double top bear flag below that low is a higher probability trade, but the stop is up here. The stop is further away, so the risk is greater. Also, you're entering later in the trade, there's less profit remaining. The risk reward of entering here is not as good as the risk reward of entering here. However, the probability that you'll make money is greater here than it is here. That's the trade-off. Some traders prefer small risk. In other words, they want a very good risk-reward equation, and they enter here where they have smaller risk. Other trades prefer to win frequently, and they go for high probability trades. However, that means that the risk-reward ratio is worse. It usually means that the stop is further away. Over the short run, a day or two or three, trading is a zero-sum game. Over the long run, years, it's not. But as a trader, you're trading either for a day, a week, or a month. You're trying to take money from very smart people, and it's difficult to do. However, that challenge is part of the fun. And if you structure your trades properly and manage them properly, you'll have a very good chance of consistently making money. An edge, a mathematical advantage, is usually fleeting and small. Even the best traders do not have a very high probability of making a big profit all the time. Any advantage that they have is small. However, if they're consistent and they're capable of consistently trading properly, that small mathematical advantage can result in very big profits over time. High-frequency trading firms, HFT, use algorithms for only days to weeks at a time before switching to a different type of algorithm. Here we have a very tight trading range. Algorithms for only days to weeks at a time before switching to a different type of algorithm. Here we have a very tight trading range. Traders look to buy low, sell high, and scalp. Everybody wants a perfect trade. However, a perfect trade cannot exist because before long, everyone would discover it and no one would be willing to take the other side of the trade and the trade would stop working. Here's a trading range. High-frequency trading firms would detect that the market is starting to enter a trading range and they would start looking to buy low and scalp and sell high and scalp because that is what is most profitable when the market is behaving like this. On the other hand, trading ranges eventually break out, as this one did here. We have a strong bear breakout and a strong follow-through bar. The market is probably going to fall for some kind of a measured move, and traders selling here have a high probability of making money. The traders who bought low, for example, traders who had limit orders to buy here, now are going to lose money. The algorithms and the style of trading that was profitable when the market was doing that are no longer profitable once the market begins to trend. In this case, the bears will not be able to sell high because the market is not high, it's only going down. And bulls buying low are going to have a hard time making money if the channel down is tight. Instead of buying low, selling high, and scalping, traders should only sell, and it's just swing trade. Bear breakout, consecutive bear bars, both closing below the low of the trading range. High probability the market will fall for some kind of a measured move, maybe based on the height of the range, maybe based upon the height of the breakout, the open of this bar to the close of that bar, measured move down. And then there will be other measured moves as the channel unfolds. Upon the height of the breakout, the open of this bar to the close of that bar, measured move down. And then there will be other measured moves as the channel unfolds. This is a spike and then a pullback, and that pullback is the start of a channel. The market became a spike and channel bear trend. And it's very tight, and when it's tight, it's impossible for the bulls to make money, and therefore traders should not buy. And when the channel is tight, it's impossible for the bulls to make money, and therefore traders should not buy. Traders looking to sell high cannot sell high because the market is only pulling back for a bar or two and never gets high. Traders have to sell for other reasons, like below bars, sell below closes, or sell breakouts to new lows. Instead of buying low, selling high, you cannot buy at all. Instead of selling high, you have to sell low. Breakouts of bear flags, attempts to reverse up. In any case, you'll be selling near the bottom of the market, betting that it will go lower, and that is the correct strategy. A perfect trade has a high probability of a big reward with very little risk. That cannot exist because there would be no to take the other side of the trade. If you have a very high probability of a big reward with very little
吃了没？你们吃了没？
吃了，
吃什么？
吃楼下的东西。
好，这有录下来吗？
我在直播。
那我进入你的直播中心的时候，
看，好看吧？
什么好看吗？
我用 GoPro 用的。
risk. No institution is going to take the other side because if your trade is perfectly good for you, it's perfectly bad for him. He has a low probability because if your trade is perfectly good for you, it's perfectly bad for him. He has a low probability of making only a small reward with a very big risk. You cannot get all three variables, probability, reward, and risk on your side. You can usually get one, often you can get two, but you can never get all three. Usually the trade-off is between high probability versus risk reward. Some traders want high risk reward that has a lower probability of making money. Other traders want high probability, but that usually comes with a worse risk reward profile, usually bigger risk, a stop further away. Again, perfect trades cannot exist because someone has to take the other side of the trade, and no firm is going to take a trade with very little probability of making money, and they only stand to gain a small reward, and the risk is big. Any trade that approaches perfection will be traded very quickly, and the opportunity will not last long. Approaches perfection will be traded very quickly, and the opportunity will not last. A small reward, and the risk is big. Any trade that approaches perfection will be traded very quickly, and the opportunity will not last long. Trading range setups are never all that clear, so the probability is not all that high, but the risk is small. Strong bear breakout, the probability is high that the market is going down further. However, the risk is usually bigger. The stop is further away. Breakout, high probability, worse risk reward. Trading range, low probability, but better risk reward. Bear channel is a breakout on a higher time frame chart. The probability is still good, but it's not quite as good as selling during the breakout. Again, the stop when you're in a trend is usually further away than it would be within a trading range. So the risk is greater when you're trading in a trend, but the probability of making money is greater as well. The market is in a cycle. It's in a trading range, and then it breaks off and enters a trend. The trend eventually becomes a trading range again, and then it decides whether to reverse into an opposite trend or to resume the trend, break below the trading range. Traders do not expect any strategy to last for too long because the market will constantly alternate between a trading range and a trend. The trend can be up or down, and in the trading range, the breakout can be down or up. Once too many computers begin to detect what the market is doing, the market usually does something else. For example, if it's in a trading range, it eventually breaks out, and if everybody starts trend trading, eventually no one will take the other side of the trade, and the market starts to go sideways. Breakouts are brief. On any chart, on any time frame, only about 5 to 10% of the bars on the chart are in strong breakouts. For example, here, strong breakout, another strong breakout here. Lots of breakouts here, but they all fail. But in general, 5 to 10% of the bars on the chart are in a successful breakout. So the opportunity to make money during a breakout is brief. And once you're in a channel, it eventually will start flattening out and evolve into a trading range, waiting for the next breakout, up or down. Entering a trade during a strong breakout is as close as you get to a perfect trade. However, the opportunity does not last long. Traders who are selling as this is falling fast and likely to break out successfully, they have a brief opportunity to sell here or here where the stop is not very far away. The risk is not great, and the probability of profit is high, and the potential for reward is big, but that is only a very brief opportunity. Once everyone sees the opportunity, you get some profit taking, and the market then gets a pullback, and the strong breakout gets replaced by some. Entering a trade during a strong breakout is as close as you get to a perfect trade. However, the opportunity does not. That last one. Traders who are selling as this is falling. If they're sensing that the market is falling fast and likely to break out successfully, they have a brief opportunity to sell here or here where the stop is not very far away. The risk is not great, and the probability of profit is high, and the potential for reward is big. But that is only a very brief opportunity. Once everyone sees the opportunity, you get some profit taking, and the market then gets a pullback. Once everyone sees the opportunity. You get some profit taking, and the market then replaced by some uncertainty and eventually a channel. Institutions detect the quick momentum down, and they're selling quickly, and that is creating the breakout. As I said, it's a brief opportunity for a trade that is as close as you can get to perfection. It does not last long. As the breakout grows, the risk increases, and all of a sudden it becomes less perfect. There's also a reasonable chance that a breakout will fail. In general, if you have a strong breakout like this, there's a 40% chance that it will fail and reverse back up, 60% chance it will go down at least for a measured move. That's when the breakout is strong like this. We have a breakout, another breakout bar, both closing below the trading range, and then no bull bar for the follow through. We have dojis here, so weak reversal attempt. This is a 60% trade, 60% chance it's going to fall for at least a measured move. Anytime a trade approaches perfection, everyone sees it and everyone starts trading in that direction. Early in this breakout, everyone is selling, knowing that probability is high of making money, and the stop is not far away. And the bar is big because everyone sees this as potentially a perfect trade. There is a risk factor, and part of it is time. The stop might not be far away, but you have the risk of making mistakes in your decision, assessing whether or not the breakout will be successful. And a lot of traders are uncomfortable making those quick decisions and placing those trades. Mistakes in your potentially a perfect trade. There is a risk factor, and part of it is time. And the bar is big because everyone sees this as potentially a perfect trade. There is a risk factor, and part of it is time. The stop might not be far away, but you have the risk of making mistakes in your decision, assessing whether or not the breakout will be successful. And a lot of traders are uncomfortable making those quick decisions and placing those trades. And therefore, they'll wait to see a couple strong closes and then sell a close down here, knowing that it's less perfect. Stop is now further away, but you still have a high probability for profit. When a trade is close to perfect, you get a huge trend bar because everybody is quickly taking the trade. And as the bar becomes big, the stop gets further away, and that increases the risk. And if you enter down here, not only is the stop further away, but there's less reward remaining in the trade. So the risk-reward ratio is becoming worse. No matter how good you are, your edge, your mathematical advantage is always going to be small. No matter how good you are, your edge, your mathematical advantage is always going to be small. The key to making money consistent is learning how to become consistently good. No one's going to give you money. Trading is always going to be hard, but that's part of the fun, the challenge. Traders always wonder if they have to be perfect. They do not have to be perfect. All they have to do is trade well consistently. Learn how to structure trades where there's a mathematical advantage, use appropriate stops and exits, and manage the trades correctly. a trader takes a trade, he's always thinking, am I going to make money if I take this trade? At least subconsciously, traders are only going to take a trade if they believe the probability of making money times the size of the reward is significantly greater than the chance of losing money times the risk, and that is the trader's equation. I'm going to talk about the trader's equation now. Traders only take a trade if they believe that the probability of making money times the potential reward is significantly greater than the probability of losing money times the risk. You know what the reward is, that's your profit target, that's the money you're hoping to make. And you know the risk as well, you know where your stop is, so you know how much money you're risking. What you never know is the probability. However, it's safe to assume that the probability is always going to be between 40 and 60%. It's closer to 60% during strong breakouts. And then in trading ranges and weaker trends, the probability is less. In a trading range, for example, sometimes it's only 40% unless you use a wide stop and scale in. This is the trader's equation. If it's positive, then it makes mathematical sense. 60% of the time and still make money if the risk-reward ratio is good enough to offset that low probability. Here's the E-mini, a 5-minute chart. And I want to talk about 10 theoretical trades. Assume you take 10 trades, and your profit target is 4 points, and you use a stop that's 2 points away. So your reward is twice as big as your risk. 4 is twice as big as 2. And let's say you only win 40% of the trades. So of the 10 trades, you only win 4 times, and 6 times you do not win. Those 6 times might be small losses, they might be small wins. Some of them will hit the stop, but none will be more than 2 points because you have a 2-point stop. For example, let's say you sell below this bear inside bar. And you sell here. You place a limit order to take profits at 4 points. And you get filled here. You have a stop 2 points above. You're risking 2 points, and you made your 4 points at the bottom of this red box. Let's say you see the reversal, you think of it as a wedge, and then a pretty good reversal, you think it's going higher, and you buy in a stop above this pullback bar here. You get filled there. Again, you place a stop 2 points down. You place a limit order to take profits 4 points up, and you get filled right there. This is another profitable trade. You made 4 points. You risked 2 points. Your stop was not hit. And let's say you sold here, took profits here. Sold here, take 4 points profit here. Here, here. On the way up, you bought above this inside bar, took profits here. You bought above here, took profits here. Many profitable 4-point trades. On the other hand, if you bought here, hoping for a reversal up, it did not quite make 4 points. You sold on the reversal down, thinking it's a minor reversal, and the bear trend would probably try to resume. You made less than 4 points. And let's say you see this as a potential double bottom, and you bought above this bull bar. You put your stop either below the low of the signal bar, or maybe the low of the bear trend, or you just rely on your 2-point stop. Let's say you get stopped out here for a 2-point loss. And then here as well, you got a high 2 bull flag, you buy, and then you got a bear reversal bar. You either exit below that bar, or you rely on your 2-point stop. You lost 2 points here, you lost 2 points here, you lost 2 points there. We have a strong trend down, strong trend up. It's easier to make money. Reasonable swing trades should win 40%. If the risk-reward ratio is good enough to offset that low probability. Here's the E-mini, a 5-minute chart. And I want to talk about 10 theoretical trades. Assume you take 10 trades, and your profit target is 4 points, and you use a stop that's 2 points away. So your reward is twice as big as your risk. 4 is twice as big as 2. And let's say you only win 40% of the trades. So of the 10 trades, you only win 4 times, thinking it's a minor reversal, and the bear trend would probably try to resume. You made less than 4 points. And let's say you see this as a potential double bottom, and you bought above this bull bar. You put your stop either below the low of the signal bar, or maybe the low of the bear trend, or you just rely on your 2-point stop. Let's say you get stopped out here for a 2-point loss. And then here as well, you got a high 2 bull flag, you buy, and then you got a bear reversal bar. You either exit below that bar, or you rely on your 2-point stop. You lost 2 points here, you lost 2 points here, you lost 2 points there. We have a strong trend down, strong trend up. It's easier to make money. Reasonable swing trades should win 40% or more of the time. And because of the strong trend, we have 10 trades, 7 of them were winners, and only 3 of them were losers. On the other hand, let's say instead of 70% win, let's say only 4 were winners, and only 3 of them. Reasonable swing trades should win 40%. Or more of the time, and because of the strong trend, we have 10 trades, 7 of them were winners, and only 3 of them were losers. On the other hand, let's say instead of 70% win, let's say only 4 were winners. So you had 4 trades, each making 4 points. Your total profit on the winning trades is 16 points. And let's say you had 6 losers that hit your stop. You would lose 12 points. Your net profit would be 16 minus 12, 4 points. Greater than 0, you have a positive trader's equation. You have 40% winners times 4 points. That is greater than 60% losers times 2 points. That's a positive trader's equation, so the strategy that you are employing here makes sense mathematically, and over time, you have a very good chance of consistently making money. The math is actually better than what I just described, because if you're swing trading, you're not going to be taking profits at 4 points. You'll hold on to the trade until it no longer makes sense to hold on to it. For example, until there's an opposite signal, or until the end of the day. Your winners, then, many of them, will be much more than 4 points. Also, 60% of the time, you're not making 4 points. That does not mean you're losing 2 points on each of those 6 losing trades out of 10. Some of the trades will be 2-point losers, some will be 1 point. You're not making 4 points until the end of the day. Your winners, then, many of them, will be much more than 4 points. Also, 60% of the time, you're not making 4 points. That does not mean you're losing 2 points on each of those 6 losing trades out of 10. Some of the trades will be 2-point losers, some will be 1-point losers, some will be 1-point winners, some will be 2-point winners. Those 60% of trades when you're not making your profit target balance each other out. Some are small winners, some are small losers. You're not going to have 60% of the time hitting your 2-point stop. I want to give an example using the euro versus the dollar forex market. Here's a 5-minute chart. I want to talk about 5 possible trades. Assume you're using a profit target of 40 pips and a protected stop of 20 pips. And let's say you only win 40% of the time. 40% of 5 trades, that means you're winning 2 trades out of the 5. We have a strong bear trend, and let's say you sold here, and you place a limit order to buy back with a 40 pip profit, and you had to stop 20 pips up. Here, the market quickly went down to your target, and you'd exit with a 40 pip profit at the bottom of this red box. We have a very strong reversal up after 3 pushes down, 1, 2, 3. Probably we'll try to get a second leg up. Let's say you place a buy stop order above the high of this bull bar, and you place a stop 20 pips down. The market turned back down, but it did not quite reach a 20 pip stop. It resumed up for a second leg, and you would have been filled with your limit order 40 pips above your entry. Another profitable trade. You buy here, stop just down here. This did not reach it, and you exit up here with 40 pips profit. The bears made 40 pips here. The bulls made 40 pips here, and again, the bulls made 40 pips here. A high 2-bull flag, 2 legs down, and test at the top of this range, and it went up 40 pips before the stop was hit. On the other hand, let's say you sold below this reversal bar. The bulls tried to create a bull trend, and the market reversed back down. However, the market reversed up from a new low. You had a profit target down here to take profits at 40 pips. You had a stop up there, 20 pips above. You sold here. It did not hit your stop. However, this reversal is a good enough reason to exit. You'd exit above the high of this bull bar, which is maybe a pip or 2 profit from this short. And then again here, let's say you bought above this bar, a wedge, 1, 2, 3, decent bull bar, and you put your stop below the low of the day, below here. You were quickly stopped out. It's less than a 20 pip loss, but you still were stopped out. Reasonable swing trades should win 40 or more % of the time. Here we have a strong trend down and a strong trend up. You probably have better than a 40% chance of winning with your swing trades. We have 3 trades that reached a swing target of twice as big as the risk. They made 40 pips while risking 20 pips, and you had 2 trades where you did not make your 40 pips. Here you might have made a pip or 2, and here you may have lost about 15 pips or so. 2 losing trades, 3 winning trades. Let's assume instead that you only had 2 winning trades. You had 2 winners times 40 pips, would be 80 pips total profit. You had 3 losers. Let's say your losers all hit the protective stop, and you lost 20 pips on each. 3 losers times 20 pips. Your total loss is 60 pips. Your net profit is 80 minus 60, 20 pips. That means that the probability of winning here, it turned out to be 40% times the reward is greater than the probability of losing here, 60% times the risk. And that is a positive trader's equation, and that means this type of strategy is mathematically profitable. You have an edge, and if you employ the strategy over time, you have a good chance of consistently being profitable. The math is actually better than that because some of the winners are more than 40 pips. If you're swing trading, you won't necessarily take profits here. You may swing part of it until the trend is no longer in effect, until the end of the session, until there's a clear opposite signal. So some of the winners would actually be more than 40 pips. 60% of the time, you do not make a swing profit. You do not make 40 pips. But that does not mean your stop gets hit during those 60% of the trades. Some of them are small losers, some of them are 20 pip losses, your stop gets hit, and some of them are small winners. And the 60% of the time when you do not make your 40 pip profit, those times tend to balance each other out. Some small winners, some small losers. I began by talking about perfect trades and a mathematical advantage. Perfect trades cannot exist. However, if you structure your trades properly, you can have a mathematical advantage, an edge. And then I moved on to talk about the trader's equation. If the probability of making money times your potential reward is significantly greater than the probability of losing money times your risk, you have a positive trader's equation, and the trade that you just structured has a mathematical advantage. You have a good chance of making money. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on the trader's equation and probability. Traders often hear about risk-reward ratios, 2 variables when you take a trade, risk and reward. There's an equally important variable that you never hear about, and that's probability. Two variables when you take a trade: risk. And reward. There's an equally important variable that you never hear about, and that's probability. You have to consider all three variables whenever you're taking a trade: probability, risk, and reward. If you want, you can think of them as simply two variables: probability and then the risk-reward ratio. If a trader sees this breakout with this big tail and then a second attempt to go up and another reversal down here, he might sell below the low of this bar and put a stop either above the high of this bar or up here. The result was a big bear trend. Whether he had to stop here or here, the risk was small compared to the reward. He ended up taking a trade that had a very good risk-reward ratio. However, selling right here, the probability that you're going to get a swing down is small. More likely, you're going to go sideways. Low probability, very big risk-reward ratio. If a trader prefers higher probability, he'll wait for the bear breakout and a follow-through bar. This bar closing below the low of the past 30 bars. The probability is high that the market's going to fall for at least a measured move from the open of this bear breakout to the close of the bear breakout, which is down here. 60% chance or more that we're falling down here. Yet, if you sell here, you're getting a high probability trade, but your stop is still here or here. So the risk is much greater than for traders who sold here. This trader had great risk-reward and lower probability. This trader has worse risk. His stop is further away, but a higher probability of making money. You can also sell below this double top bear flag, below 1, low 2, double top this high, and this high. That is also a high probability trade for making money. But again, the stop is up here, and that's the trade-off. You either get a high probability of making money, it's always accompanied with bad risk-reward, or you have a trade with excellent risk-reward, that's always accompanied by bad probability. For every trade, there's always one institution buying and another institution selling, and there has to be a reason for both of them to take the trade. In general, it's a trade-off. One trader gets better probability and worse risk-reward. The other institution gets worse probability but better risk-reward. Both are acceptable if you manage the trade correctly. Should you buy or sell? You choose the variable that's more important to you. Some traders always try to take high probability trades because they like to win a lot. However, that always means smaller risk-reward. In general, the risk is greater, the reward is less. Other traders really focus on big reward. They like to get very big winners. However, when they do that, it's always accompanied by lower probability. I want to make a point about risk, reward, and probability. I'll use lottery tickets as an example. The trader never gambles because the casino or the state sets the rules, and the rules are designed to guarantee that the casino or the state will make money, even if an occasional gambler gets rich. That is not trading. However, I want to use gambling, in this case a lottery, to illustrate the trade-off that exists between risk, reward, and probability. When trading, you have two rational people trading with one another. If one side has great risk reward, the other side has great probability. There has to be a reason for both sides to take the trade, and they can be profitable taking either side, great risk reward or great probability. Now, let me go back to the example of the lottery. Let's say you buy a ticket for $1. Therefore, the most you can lose is $1. Your risk is very small relative to your reward. In this particular case, you could win $750 million. So tremendous risk reward. However, whenever you have excellent risk reward, you always have low probability. That means you'll lose most of the time. The odds are overwhelming that you'll lose. There can be no perfect trades. If you have great risk reward, you cannot have very good probability because no one would take the other side of the trade. If you have great risk reward, very little risk, tremendous reward, and a high probability of winning, who's going to take the other side of the trade? They'll have big risk, they'll have very little reward, and very low probability. Nobody's going to take that other side of the trade. And therefore, a perfect trade can never exist. If you have great reward, that always means that the probability is low, and that means that you'll lose most of the time. In this particular case, in the case of a lottery, if you have great risk reward, you have very little risk, and you have tremendous reward, the ticket seller, the person selling, you buy the ticket, they sell the ticket, the state, they have a very high probability of making money. But they're not making much money. They're only making $1, and they're risking $750 million. So their risk reward is horrible, but the probability is very, very high. Now, in a lottery, or in any kind of casino gambling, the state has 100% probability of making money. How does it do that? In the case of a lottery, the prize money is always going to be about 40% of the total ticket sales. And therefore, if the state sells $1 million in tickets, they're only going to give away $400,000 in prize money. If they are giving away $750 million in prize money, that means they're selling about $2 billion worth of tickets. So they're setting it up so that they have a 100% probability of making money. That is not trading. Again, that's gambling. Again, when you're trading, not gambling, not buying lottery tickets, when you're trading, whenever you take a trade with great risk reward, you're probably going to lose on any one trade. That is a swing trade. A swing trade is a trade where the reward is greater than the risk, and the probability is in general about 40%, sometimes 50%. You only take a swing trade if you structure it in a way so that you'll get an occasional big reward that is big enough to offset the frequent small losses. If you're taking a high probability trade, in other words, a very big chance that you're going to make money, your risk is always going to be high relative to your reward. For example, you might be risking $100 to make $5. This is scalping. A scalping situation is a trade that has a high probability of making money, but the reward is small relative to your risk. A swing trade is the opposite. You have a low probability, a relatively low probability, but your reward is greater than your risk. Most traders have a better chance of making money if they swing trade. That means going for a reward that is at least twice the risk. Usually you'll achieve at least that goal 40% of the time. 60% of the time you'll have small wins and small losses that offset one another. When traders start out, they work really hard to save enough money to trade. The one variable that they consider far beyond any other is risk. They don't want to lose money. They're afraid that if they lose money, they'll lose their account and they'll lose their dream. It'll be the death of their dream. So it's the equivalent of dying. And when traders begin trading, they tend to focus only on risk. And they often totally ignore probability, which is unfortunate because you need to pay attention to all three variables if you're going to trade profitably. Beginners are always looking for the lowest risk trades, and they lose money. And it's because they don't understand that a low risk trade means low probability. That means you're going to lose most of the time. And then if you add to it poor management because of inexperience, your losses are going to be bigger and you're going to lose even a higher percentage of the time. It doesn't matter whether you take a trade with a great risk reward and lower probability or a trade with a higher probability and worse risk reward if you manage the trade properly. Both are reasonable ways to trade. Both have positive traders' equations. Some traders don't worry too much about picking exact tops and bottoms. A lot of them will wait for a pullback or a breakout because then the probability of making money is higher. They'll sell the breakout or they'll sell the bear flag, the pullback from that breakout. These traders are comfortable having a stop far away, either here or here, because they know the probability is high that they'll make money. That bigger risk is the price they pay to get the high probability of a profit. Experienced traders will sometimes take lower risk, lower probability trades. Other times they'll take higher probability, bigger risk trades, whichever one they feel like gives them the better edge. For example, if a trader has to leave soon and they cannot stay to watch the trade all day, they need a high probability trade. They need a quick profit, a small profit. A small profit means a small reward. It's a scalp. That means if they're going to take the trade, they're expecting to win a high percentage of the time. The best way to improve a risk-reward ratio is to swing trade. Go for a very big reward. For example, sell and you stay short until the market either reverses or until the end of the session. Let's say a trader sells below this low and uses a very tight stop just above the high of that bar. So they get short right here below that bar. If he's a scalper, he might get out with 1 times his initial risk. His initial risk is above the height of the sell signal bar. He entered here, and this is 1 times his risk. A swing trader, on the other hand, will stay with the trade until the trade is no longer valid. Here, 3 pushes down, 1, 2, 3, a parabolic wedge. We have a bull bar closing on its high. Maybe we'll get a minor reversal. This is a reasonable place to exit, but look at the size of the reward. Entering here and exiting here, risking to here or here. So excellent risk-reward ratio, but low probability. 40% chance he's going to get the swing down. 60% chance he's not going to get the swing down. Either the market will go up and hit a stop, or it'll simply go sideways. The huge reward relative to risk more than offsets the low probability of a very big profit. It's reasonable to sell there. There's another way to improve the trader's equation, and that's by scaling in. Adding to a position, even if it's a losing position. Beginners should not do that. Scaling into a trade increases the probability of making money, but you pay for that with a worse risk-reward ratio. You're increasing your risk, and you're usually reducing your reward as well. For example, we have a bear trend, but we have 3 pushes down, 1, 2, 3. It's a parabolic wedge, consecutive sell climaxes, and there's a bull bar, consecutive bull bars. This is not a high probability sell. However, the reversal up is probably only going to be minor and will probably test back down. When you have a very tight bear channel, the first reversal up is minor, and you're usually going to test back down. The bears sell here, hoping it'll continue down, but confident that the first reversal up will not go far. They can sell more and then get out around their original entry price, break even on their first short, and then with a profit on their second short. Sell more, maybe below here, a low 2 or low 3, low 1, low 2. Maybe this is a low 2 and this is a low 3. It's still below the top of the sell climax. It's still below the top of the bear leg. Chances are the market's going to test down to this area. Maybe a stop at the top of that most recent bear leg. He gets out when the market comes down to his original entry price at the low of that bar. He sold just a little bit below that bar. He might get out at the low of that bar and take a tiny loss, or he'll get out just below the low of that bar and get out break even on his first entry, and he gets out with a profit on his second entry. He increased the probability of making money by adding to his position, but he's also increasing his risk. Instead of risking from here to here, he's additionally now risking from here to there as well. So he increased his risk to get the higher probability of making money. Again, only experienced traders should do this kind of a thing. bear trend, a bull breakout, and a higher low, and now we have a double bottom. If you want, you can call it a double bottom, higher low, major trend reversal. You can call it a double bottom, bull flag. So bull breakout, a pullback, and then now a double bottom, and possibly a bull trend. In any case, we have a bull buy signal bar. Traders will buy above that buy signal bar, and some of them will put a stop just below the double bottom. Very small risk, and that immediately tells you the probability is low. If you take this buy, you're probably going to lose money. It's probably going to fall below that bar. Whenever the risk is small, chances are you're going to lose. Stop just below the double bottom. You're just buying in the middle of a tight trading range. Most attempts to break out of a tight trading range fail. Attempts to the downside or attempts to the upside. A trader, on the other hand, might prefer a high probability trade, and here we have a very big bull breakout bar and a second consecutive big bull breakout bar. There's a 60% chance after a strong breakout like this that the market's going to rally for at least a measured move up based upon the open of the breakout to the close of the last bar of the breakout. 60% chance we're going up here. High probability, but the stop is still down here. This trader put his stop here. The trader who bought that close, his stop is here as well. He has a much higher probability of making money, but he also has a much greater risk than the trader who took the initial buy. A triangle, 3 pushes down, 1, 2, 3, 4, in a bull bar. It's still a high probability that the traders will make money if they take the buy above that bull bar. The probability here is not as high as the probability here, slightly lower probability, but still close to 60% that you'll make a profit buying above that bull bar. Buying the breakout, very high probability. Buying the pullback, slightly higher probability. Buying the pullback here, slightly lower probability. Buying here, again, lower probability the higher up you go. We have a bull trend and a bear breakout in a tight trading range. In the tight trading range, we have a double top, lower high, and a bear bar closing on its low. This is a reasonable short. You sell below that bear bar for a double top, lower high, major trend reversal. Stop above that high. Very small risk, and that tells you immediately you're probably going to lose money. 60% of the time, you're going to lose money. 40% of the time, you're going to get a swing. But the swing is so big that it more than offsets the loss. It's reasonable to take that low probability short. Other traders prefer high probability trades. They'll wait for the bear breakout. We have consecutive big bear bars closing below the low of the past 50 bars. High probability that we're going to fall for at least a measured move down. From the open of the bear breakout to the close of this bar, we're going to fall for a measured move down 60% of the time. We're getting a pullback, so increased uncertainty, but it's still a fairly high probability short, either below this bar or that bar. Again, whether you take the short here or here, the stop is still here. So the risk is greater for these high probability shorts compared to this short, but the probability of making money is greater as well. I've met many traders over the years who win 90% of the time. Without asking them, I automatically know that they are scalping. If you're winning 90% of the time, you have to have a bad risk-reward ratio, and that usually means a very small profit. In other words, you're scalping. You cannot get a great variable, 90% probability, without giving something up, usually risk-reward. And that means you're always giving up risk-reward. Usually it means you're taking a small risk and a small profit. I have a high probability of winning, you have a good risk-reward. That means you lose a little, and I make a little, but I have a high probability of success. These are all examples of scalps. You buy here, you scalp out. You've got a small bull flag, you buy below the bull bar, you bet against the reversal down, you buy that low, you buy the reversal up. These are all high probability trades if you're taking small profits. Therefore, they're all scalps. Selling here, 3 pushes up, 1, 2, 3, small wedge, bear bar, probably going to turn into a trading range, high probability, small risk. And then these are all scalps. Sell the close, sell the low 1, sell the low 2, sell the breakout, sell the double top bear flag, sell the breakout low here, sell the close, sell the low 1 short, all the way down. Lots of scalps. High probability of success if you're taking a small reward. In other words, if you're scalping. Whenever you take any trade, you automatically know the risk and reward. For example, if you're buying, you should automatically, as soon as you enter, put in both a stop to sell if the market goes against you, and another order to take profits at a reasonable target. That distance to the profit-taking order is your reward, and the distance to your stop is the risk. You always know the risk and reward with every trade. However, you don't always know probability. In fact, you never know probability. The risk is the number of ticks or pips to your protective stop. The reward is the number of ticks or pips to your profit-taking limit order. The probability is very, very important, but it's never clear, and most traders ignore it, which is too bad because you need to pay attention to it if you want to structure profitable trades. A reversal down, a pair of strong bear bars closing on their lows. You sell the close, a high probability short. Your stop is either above this sell climax or above the top of the bear leg, so you know how much you're risking. With a high probability trade, you know the probability is you'll make at least a reward equal to your risk. You sell that close, stop here, or here, and measure move down is here, and the reward is here. A reasonable place to take at least partial profits. A high probability trade, the reward is only equal to risk, so your risk-reward ratio is 1. That's a low risk-reward ratio, but it's mathematically okay because the probability of making money is high. Strong bull breakout, I always look to the left. I want to make sure that the market is above prior highs. That might be a bull trend. And if I get a strong reversal down, I look to the left as well. Big buy climax, it could fall below that low and still be in a bull trend. If it falls below the bottom of the bull trend, then it's no longer in a bull trend. It's then either in a trading range or a bear trend. Whenever you have a strong breakout like this, high probability that you're making money, but you do not yet know if it's a bull leg in a trading range or a bull leg in a bull trend. Not great follow through, might get a deep pullback, but as long as the pullback stays above the bottom of the bull trend, it's still possibly a bull trend. With this big of a reversal, big up, big down, it generates big confusion. Probably the market's now in a trading range. However, as long as it stays above this low, it's not in a bear trend. It's either in a trading range or a bull trend. Strong reversal down and strong follow through. At this instant, the market's always in short. However, it's still above this low. It could simply be a deep pullback in a bull trend or a bear leg in a trading range. Some bears will sell that close. In general, I do not, because it's still around the low of the buy climax and it's still above this low. So that is not a high probability sell, even though you have consecutive bear bars. Look to the left. We're still possibly in a trading range or possibly in a broad bull channel with higher lows and maybe even higher highs. It's always in short, but unless you get strongly below the bottom of this buy climax, it might be simply a bear trap, trapping traders into selling low in a bull channel or trading range. You cannot tell in this chart, but this low actually fell a tiny bit below the bottom of this buy climax. And that's common. If you have a buy climax and a reversal down, Usually the market tries to fall at least a little bit below the bottom of the buy climax, and then it decides whether to form a double bottom with that buy climax and resume up, or break below it and fall for a measured move based upon the height of that buy climax. For the bulls, it's still a bull trend, and it's a double bottom with a buy climax low. It's also a higher low, it's above this low, and it's above that low. Yet, whenever I see a reversal down this far in a bull trend, chances are it's not going to be a strong bull trend. More likely, it's going to be big up, big down, big confusion, and confusion usually means trading range. Bulls will buy the reversal up. You buy low, sell high, and you take quick profits. It's reasonable to buy this low. It's a double bottom with that low, and it's still above the bottom of the bull trend, so it's still a higher low in a possible bull channel. More likely, you're buying low in what will become a trading range. Bull trend and pullback. As long as the pullback stays above a 50% retracement of the buy climax, the probability favors higher prices. But the risk is greater because your stop is down here or down here. If the market falls below the midpoint, the probability for the bulls is less, but so is the risk because you're closer to the stop. So buying down here, you have less probability of a bull trend, but you also have less risk. Buying up here, the probability is good, better than 50-50, that you'll make money, but the risk is far away, and the reward might not be all that great as well. We have a weak rally, we're probably not going to go much higher. Buying up here, stop down here, not much reward, bad risk-reward ratio, but high probability. So traders buying up here, good probability, but bad risk-reward. Once it dips a little bit below the midpoint, probability drops to about 50% that the market is still in a bull trend. But the risk is less, so if you buy here, you're closer to the stop here or here. It drops to about 50% that the market is still in a bull trend. But the risk is less, so if you buy here, you're closer to the stop here or here. You're getting better risk-reward, but lower probability. If you're buying in the bottom third, the probability is less that the market's still in a bull trend. Maybe it's only a 40% chance that we're going up to a new high. But the risk is less as well. Because the stop is here. Whether you buy up here, here, or here, the stop is still here. As the market falls, you're getting closer to the stop. If you're entering down here, if you're buying down here, you have less risk. But after this much of a reversal down, retracing all of the bull trend, you have less probability of the market making a new high. This is the most important price for the bears. It's the bottom of the bull trend. The bears want to get below this low, because if it gets below this low, the market's no longer in a bull trend. It's then either in a trading range or a bear trend. As long as it stays above this low, it's either in a bull trend or a trading range. When you're getting a sell-off like this down to the bottom of the buy climax, you just don't know if it's simply a test of the bottom of the buy climax. As I said, when you get a reversal down after a buy climax, the market usually gets at least a little bit below the bottom of the buy climax. And then you don't know if there are a lot of dollars buying down here, looking for a trend resumption up. Is the market going to form a higher low and be in a broad bull channel? Or is this an actual reversal that will break below the bottom of the bull trend and become a bear trend? Strong reversal up, 5 consecutive bull bars, 8 bars without a bear body. We're back to always in long. That makes a bear trend unlikely. Now we're probably either in a bull trend or a trading range. Anytime I see a strong breakout, I always look to the left. Is the breakout above all of the bars or just above some of the bars? If it's still below this high, this rally could simply be a second leg up in a broad bear channel. First leg pullback, a second leg, or a second leg up in a trading range. Even though the market is always in long, maybe by the close of this bar, that does not mean bull trend. It could simply be a bull leg in a bear channel or a bull leg in a trading range. Breakout, follow through. You can call it head and shoulders bottom, left shoulder, head, right shoulder. Bear trend, higher low, major trend reversal. A breakout and follow through above the neckline. We're always in long. We might go up for a measured move. It might in fact be the start of a bull trend. But unless it gets above the top of the most recent lower high, it's still in a bear trend. And this could be simply a bull leg within a broad bear channel or a bull leg in a trading range. Traders will buy the close, confident that the probability is high, that we're going at least enough up to make a profit. However, unless we get above this high, this rally is simply a double top lower high, or you can call it simply a lower high and possibly a broad bear channel, and traders will wait to sell the reversal down. 2 legs up, 1 pullback 2. This could be a second leg trap, trapping traders into thinking it's a bull trend, but if you look to the left, we have not gone above the most recent major lower high, and therefore this could simply be a trap, tricking traders into buying too high in either a bear channel or in a trading range. You can sell the reversal down there, or higher probability sell this reversal down here, double top bear flag. Strong bull swing, but still possibly a pullback from this strong leg down. Unless we get above that high, a major lower high, no matter how strong this rally is, it still could be simply a pullback from the sell-off. Here's a 50% pullback. As long as the market stays below the 50% pullback, then the probability is at least 50% chance that we're going lower. Below the 50% pullback, the probability favors the bears. The bears selling here have greater risk. They have higher probability. That's always accompanied with greater risk. The bulls need to break above this lower high. Otherwise, we could still be in a bear trend. Again, if it gets above the lower high, it's no longer a bear trend because a bear trend needs lower highs. Down here, the risk is great for the bears. Their stop is way up here, and the probability is high. If you're selling down here, the reward might simply be a measured move down based upon the height of this trading range. We have a double top bear flag, and the risk is greater than that. The distance to this high, if you're selling down here, is greater than a measured move down. We have a double top bear flag, and the risk is greater than it is high. Down here, the risk is great for the bears. Their stop is way up here, and the probability is high. If you're selling down here, the reward might simply be a measured move down based upon the height of this trading range. We have a double top bear flag, and the risk is greater than that. The distance to this high, if you're selling down here, is greater than a measured move down. So the reward is less than the risk. So it's a bad risk-reward ratio, but a high probability of making money for the bears if they're selling down here and stop up here. If you start selling above the 50% pullback, the risk is getting less because the stop is getting closer, and the probability is getting less as well, the probability for the bears. And if you're selling in the top third of the bear leg, there's a greater chance that we're going to break above the protective stop, a greater chance that this is a trading range instead of a bear trend. There's 60% chance of the bulls getting above that high, and only a 40% chance of the bears getting to a new low. But the risk for the bears is less because they're very close to the stop, and the reward is greater. It's very far away. Bears selling up here have a much better risk-reward ratio, but a much smaller probability of making money. Down here, bears have worse risk-reward, but higher probability. In the bottom half of the bear trend, the probability favors the bears, 60% chance we're going to a new low. And the probability gets less the higher up the market goes, and the risk-reward ratio gets better for the bears. The risk is less, and the reward is greater. In the top third, the risk-reward clearly favors the bears. The chance of a new low is less, but the reward is very big relative to the risk. When you have a strong rally like this, but it's below the top of the bear trend, you don't know how many dollars waiting to sell. How many dollars view this as simply a buy vacuum test of resistance? Is this simply a second leg trap, leg 1, pullback, leg 2, with a lot of bears looking to sell in the upper third? You don't know until you see the reversal down. The probability favors the bulls, but the risk reward is better for the bears. There are always bears willing to sell. Once you see the reversal down, the probability is getting better for the bears, but if you sell down here, the risk is greater. In this video, I talked about risk, reward, and probability, and I tried to emphasize the importance of probability. A trader cannot simply think about a risk-reward ratio. A great risk-reward ratio is meaningless if the probability of making money is very small.
休息休息。